Hi again, this is Don Miller. In our last video, an Introduction to Technical Analysis, we discussed the relevance and significance of using multiple time frames to gauge market opportunity and profit potential. For example, we discussed using the combination of daily and weekly intervals to determine the market bias, both on a shorter-term basis and on a longer-term horizon. In this video, I would like to emphasize that these are the same techniques that professional traders have been using on shorter time frames for decades. In these charts, the top two charts reflect the 5-minute in the top left and the 60-minute interval in the top right, two time frames that traders have often used to gauge market opportunity on relatively short time frames. On the other hand, the two charts at the bottom reflect the longer-term daily and weekly combinations that we discussed in our last video. The significance of this slide is the similarity between cycles that professional traders have seen, monitored, and traded for decades at the top on shorter time horizons with the cycles shown in the larger time frames. That is because the market does the same thing over and over again on different time horizons. It's a little bit like nature, where you'll see things operating relatively quickly on shorter time frames and then unfold more slowly over longer time horizons. Yet in both cases, the cycle of evolution is identical. The only difference is the time frame. One of the advantages we have at Pivot Point Advisors is being able to take the tens of thousands of hours of experience trading financial markets on shorter term horizons and applying those effective tools and techniques to longer term portfolio management. By knowing when to get in the market, when to stay in the market, and when not to be in the market is of course very important to optimizing any portfolio. And while no method is certainly perfect, these indicators and techniques can effectively help us identify the appropriate risk-reward balance at any given point in time. And we believe that risk is as important, if not more important, than reward. Simply put, there will be times when the market is objectively telling us it's simply too risky to be in an equity position. Imagine, for example, being fully invested or even partially invested in the market prior to the 2008 decline, when the market was clearly providing an indication that the path of least resistance was down. Many of you may have gotten caught in that, and that is unfortunate. Yet by using objective technical analysis and not a subjective model that assumes that one must always be invested in equities, a given percentage, we believe that we can help you minimize the risk of loss and still provide you with the opportunity for gains which have higher probability than simply always being in the market. This is how professional traders have always viewed their business, and it's a process that we're taking to the next level in terms of portfolio optimization. While there's certainly modest risk in any opportunity, it's our job at Pivot Point Advisors to minimize that risk for you, keep probability on your side, and keep risk on the other person's. I hope you found this helpful. Thank you for viewing, and have a great day.